For more now in the markets, where the markets could be headed as many Americans receive stimulus check. Let's bring in Valerie Grant, Senior Portfolio Manager at AllianceBernstein, and Barry Knapp, Managing Partner and Director of Research at Ironside Macroeconomics. Valerie, if you had to pick the top three things to be watching, is the $1,400 checks or the stimulus package itself, is that as important as just the reopening trade? And how much do we have to be concerned with rising interest rates?
I actually think that the fiscal stimulus and the reopening trade, so to speak, are quite interrelated. In addition to that, I'm also very much focused on climate change from a medium and long-term perspective. And here's why I think that those two issues that I mentioned are interrelated. Because the fiscal stimulus will go to low and moderate income households, it will basically create a bridge while we're in this process of vaccination and trying to control the vaccine for individuals who've been most adversely affected. And so the stimulus will likely create consumer spending, particularly in the lower and moderate income cohorts. And in addition to that, I think for the financials, where we were very concerned about the credit quality and what was actually sitting on their balance sheets, it's probably not going to be as pessimistic an outlook as we had expected. So I think those are very much interrelated.
Barry, I'm looking at one of your latest notes and trying to figure out what you're trying to say here. Rising inflation compensation and tailwinds at maximum velocity. What do you mean?
Well, there's three real tailwinds that we thought would be big drivers of stock prices this year, and that's a global manufacturing and trade recovery, not just from the pandemic, but also from the trade war. And so in the second quarter, as supply chains clear, that'll be at maximum velocity, if you will, right? There'll be a lot of trade and manufacturing activity that'll create a fair bit of dollars as well. U.S. is a bigger importer than exporter, and that will create liquidity unto itself. The second big tailwind is capital spending, and that was also depressed by the trade war. You've already seen a pickup in R&D spending at the big tech companies, healthcare companies, and the like. Capital spending through equipment has picked back up. That should really accelerate and become increasingly apparent in the second quarter. That's good long-term news for the market from a productivity and hiring perspective, right? You need to put bodies in the seats if you invest money in capital. And the third tailwind is reflation and prices going up as a consequence. And so all those things will be moving together in the second quarter because of the liquidity from the Treasury drawing down their general account, the checks going out, Fed asset purchases continuing, and the Fed being determined not to, talk about tapering too soon. So second quarter, you're going to have all of those things really at their maximum point of velocity. And it's hard to see how the stock market can have much of a setback in that environment.
Valerie, we're going to pay for some of this stuff, and that's the stimulus deal is done. That's what the Journal's pointing out now. The powers that be are trying to figure out whether we borrow more, whether we tax. Could that be a potential headwind down the road? Higher taxes, more borrowing. Either way, we have to pay the piper someday for all of this stimulus.
Well, I think certainly that those issues will be worked out in due course, but I don't know that they'll necessarily be determinative. So when I'm looking at stocks and trying to understand some of the fundamental drivers, I'm really focused on some of the longer-term secular trends. And as I mentioned before, climate change is one that I think is very important because it's been interesting to see that companies are actually making commitments. They're investing in capital and they are investing in R&D, as my colleague just mentioned, really focused on renewable energy. And that is absent any type of additional regulation or carbon tax or anything of that nature. It's simply based on how they view the business opportunities and the economic return. And so I'm really focused on companies that are leaning into that, so to speak.
Shepard Smith here. Thanks for watching CNBC on YouTube.